Bye.
Good afternoon and welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. We've been coming to you live from Philadelphia at Nasdaq and Villanova School of Business ETF Synapse, where we've been focusing on research and academia in the ETF space. Joining me for this segment, we have Henry Hugh. He's here all the way from the University of Texas Law School, and we're going to focus on the regulatory framework around the ETF industry. Thank you so much for joining us at Synapse today. And let's get your overview. What does the framework look like right now?
Right now, there is no framework. That's the striking thing. It's more of a regulatory state of affairs that you end up having ETFs being regulated by a motley group of statutes intended for fundamentally different products like mutual funds, commodity pools, and ordinary operating companies. And then, so they squeeze them into these regulatory cubby holes, and then layer on top of that, because they don't work very well, individualized exemptions from the statutes and also changes in listing standards. So that's one of the reasons that motivated a professor at Yale Law School and I to offer, to show the need for a regulatory framework and to offer one. So it's the first kind of attempt at offering a regulatory framework for exchange rate funds.
Is the SEC proposal rule, is that part of that?
We filed, we posted our initial versions of our regulatory framework in March on SSRN, and I followed it up with an op-ed in Financial Times, and people such as Commissioner Hester Pierce, a week after its posting, cited it, and the industry seemed to react. And in terms of that June SEC proposal, they did cite this article multiple times. Now, so in terms of this proposal, I think that it's certainly a step in the right direction. That is, towards a more generalized approach to ETFs, but it's not anything like a full regulatory framework.
Right. So what would your framework, how would it help the industry? What does it look like relative to what it is now?
So that is that all ETFs will come under the same regulatory umbrella, whether it's an investment company ETF, such as SPY, or a commodity pool ETF, such as US oil, or what we call an operating company ETF, such as GLD. So that in terms of the, in contrast to what the SEC's June proposal has done, which is they only address certain investment company ETFs and don't address at all commodity pool ETFs or operating company ETFs. And they also only deal with the issue of these individualized exemptions that have been in place, but don't deal at all with the Exchange Act kind of listing standards issue. So it's a very much a commendable step, but it's a step in the right direction, but there is so much more to do. And some of the long-standing problems in terms of the existing system, still hold.
Right. So with this framework, is it a one-size-fits-all solution? Because there are ETFs out there, say levered ETFs, for example, or the more exotic ETFs that have the futures component and the options component. Would that satisfy the requirement as well for those kinds of ETFs?
Well, that's interesting you should mention about leveraged and inverse ETFs, so that under the existing regulatory state of affairs, only two particular ETF sponsors are allowed to introduce new leveraged or inverse ETFs. Now, that doesn't make any sense, because say that leveraged and inverse ETFs are bad, okay? If you assume that,
right,
then you shouldn't allow anybody to introduce them. Why are you allowing these two? Or if they're good, why are you only limiting it to these two?
Right.
Why are you just giving a duopoly to these two sponsors? Well, in terms of the June SEC proposal, they don't do anything to address this problem. They still have the current situation in place, that is, ProShares and Direction having this duopoly. Under our approach, we have where we cover basically the whole range of possibilities in terms of ETFs. Most new ETFs would just fly right through without serious SEC review, but there are certain principles you apply where that would trigger possible close regulatory review. For instance, if the product is really risky or complex and investor suitability rules are not sufficient to counter that, hey, maybe you should look carefully. Or, for instance, if the particular product may have introduced serious negative externalities that is affect the stability of the underlying stocks and things like that, hey, maybe you should look carefully. Or if you have worries about how well the arbitrage mechanism would work, hey, maybe you should look carefully. So rather than marking out, for instance, leveraged or inverse products for this kind of weird treatment, you apply these principles to whatever form of new product comes along. So this way, it's a very dynamic process, robust to innovation that is a hallmark of the ETF industry.
Right. So the framework would keep up with the innovation.
Exactly.
You don't have to keep revising every so many years.
Exactly. You got it precisely, Joe.
All right.
So our system is much more robust to the innovation process.
All right. Well, thank you so much for joining us.
Okay. Thank you so much.
And thank you for joining me throughout the day in Philadelphia. I'm Jill Malandrino, Global Markets Reporter.